Live from New York City this morning. Good morning, good morning. Looking to achieve something we couldn't achieve yesterday. Getting these gains to stick. Equity futures positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, we begin with the big issue, waiting for the next shoe to drop.
The last shoe to drop that we could see is earnings. Second and third quarter earnings.
The question is now on earnings.
It is an extraordinarily tough environment in which to forecast.
I do not think earnings have been well understood.
The market's expecting around 220 peak earnings.
Analysts are sitting there like deer in headlights.
PEs have started to contract.
Something of a consensus that believes that earnings are too high.
There's a little bit of a wait and see.
They're going to have to come down at some point.
The market will have to fall further.
There's very little proactivity among the bottoms-up analysts.
I think it's going to be a challenge.
We just don't see how we don't get a recalibration here.
Joining us now to discuss is Bowersock's Emily Hill and Krishna Memani of Lafayette College. Emily, first to you. Do you agree that's the next shoe to drop? What happens with earnings?
Yes, I do. We're already seeing forecasts revised downward, and I think it would be actually a surprise if we didn't see disappointing earnings coming across in the next quarter. So, yes.
I want to share that Lisa Shallett quote with you, Krishna, and just really elaborate on it if you can. Economists have begun to cut their top-down economic forecast for GDP, and yet fundamental company analysts are sitting there like deer in the headlights, not knowing what to do with the numbers. Krishna, so much of this seems to be obvious to so many people, yet the downgrades aren't coming through. We're not seeing the cuts. Why do you think that is?
Well, I think the primary reason for that is growth is still decent. And the headline, the top line revenues, which have to come down, haven't really started coming down as much. So I can see why the analysts are kind of waiting to see how things will work out. There is a likelihood that earnings go down, but I think in the current environment, unless things slow down substantially, and that's probably not happening this quarter or next quarter, I think earnings would be okay. Even if they do come down, they're not coming down a lot.
Krishna, just to be clear, where do you expect the economic pain to turn up in 2022?
Well, so I think, again, the policy acts with a great deal of lag, and that's something that we have to realize. You know, the tightening that has taken place and what is going to take place in the future, the impact of that is probably more in 2023 than it is in 2022.
Emily, would you agree with that assessment?
I'm sorry, I don't agree with that assessment, because I think one of the things we're seeing is that input costs have risen substantially, and we're finally starting to see declining consumer demand. You know, the American consumer is just the engine that won't quit, and despite poor, very poor, record low consumer sentiment, we'd still seen consumers have continued to spend, and we're finally seeing that fall off. So I think the impact to earnings is going to come sooner, perhaps, than you expect.
Krishna, what's the counterpoint to that?
Well, so again, I go back to the fact that policy, monetary policy, the impact of that on growth and the impact of that on outlook for growth is substantial. But the impact of that on growth itself acts with a great deal of lag. So we are going to see, and you see that in employment. That is, the impact will be there, but it is not going to happen immediately. It's going to happen with a few quarters lag.
Emily, you expect to see the pain sooner. So walk me through where you expect to see that concentrated. Is that a broad-based story across a range of industries, or is it more concentrated for you?
Well, I think we're going to have it's going to be concentrated in consumer discretionary, in the sectors that are responsive to consumer demand. And I do agree that the monetary changes that the Fed is instituting will take longer to reverberate through the economy. But some of this, the impact on consumer demand, look, there's been massive wealth destruction. $15.5 trillion of wealth has disappeared. So this is where, and $2 trillion of that alone is in cryptocurrencies. So, this is somewhat arguable, but with every dollar of wealth decline, consumers typically spend about 3 to 5 cents less. So it's actually been surprising that the American consumer has just continued to spend right through this rising inflation, through this onslaught of bad news. And so I think the parts of the economy that are dependent on consistent consumer demand will struggle, not just in 2023, once the impact of tightening reverberates through the economy, but in the next quarter or two.
Krishna, it's hard to push back against that. Goldman seems to be on board with it. A range of price target cuts in the last 24 hours on a range of retailers, Walmart, Target, Restoration Hardware. Is there any pushback from where you're sitting against that view when it comes to consumer, Krishna? Then that pain is going to come very soon.
Well, I think for consumer pain to materialize, it won't be because of wealth effect. The net impact of wealth effect at most is probably 1% in growth terms. Where the consumer is going to hurt is when employment starts coming down. And that hasn't really happened. If it had happened, the party that would be most thrilled with that would be the Fed. That certainly hasn't happened. And as long as employment remains good, consumption is going to will remain supported. It's definitely going to soften, but saying that the impact of the wealth effect and the price increases, the impact of that is going to be substantial in 2022, I find it hard to believe.
24 minutes away from the open, and Bell equity futures positive about 0.5%. Nike One stock we've been watching since the close yesterday. That stock is down a little more than 2%. Same old story. China, supply constraints, all of the above. Taylor Riggs has more. Hey, Taylor.
And John, this will get us into that story, right, about some of the supply chain issues, some of the bullishness, some of the health of the U.S. consumer. First, let's sort of come into this thinking about where the strategists are, the great conversation you've been having in the last 6 minutes. S&P analysts, according to a survey that we've done, are actually some of the most bullish they've been in about 20 years. I'm looking on a scale of 1 to 5. If 1 is a sell, 5 is a buy. On average, analysts are about a 4, the highest and sort of most bullish that they've been since about 2002. I think what's interesting when you look at this chart is it's actually they're the most bullish in the top quintile for the stocks that are off the most relative to the 52-week high, on average a 29% drop. So is that a lot about a valuation story, right? Coming in and just thinking that they've sold off so much that they're actually starting to look attractive. Let's end on Nike, where we started. When you think about sort of the Goldman strategists coming in and saying profit margins are too rosy, we heard a little bit of this with Nike yesterday. The health of the North American consumer, which has been the huge sort of bullish story of Nike, falling just a little bit. If that top line starts to fall just a little, how does that impact the bottom line? That is sort of the big question when you think about the equity market rolling over, but profit margins and the profit margin forecasts are steady. How does that work out? How does that sort of divergence go from here?
I'm trying to work out a whole range of these issues. On the one side, Taylor, you've got the likes of Goldman saying things are too rosy, and then you've got Citi saying things will be better than feared. On the earnings front, then you've got JP Morgan saying that the average investor expects an economic disaster. I'm not sure how you gauge what the average investor expects or how you come to the conclusion that they expect an economic disaster. At the same time, Taylor, I'm looking through this in the same way you do. Everyone says things are very gloomy, but I look to Wall Street and it looks very divided. I can still find some big bulls out there on this equity market.
I'll bring you one, maybe Jonathan Golub, right? You know,
sure.
He's more of the quant at RBC, and he said that sort of the indicators that he's looking for, the dispersion in those analyst estimates aren't there. Once you start to get more of that big divergence, maybe you'll start to show some cracks. But for now, I think pretty positive, according to him.
Taylor Riggs, thank you. Wonderful to catch up. Taylor with us through the hour, hopefully, for a few more times. I want to share this quote with you from JP Morgan's Marko Kolanovic, who said the following. It's not that we think the world and economies are in great shape, but just that the average investor expects an economic disaster. And if that does not materialize, risky asset classes could recover most of their losses from the first half. Now, it's not for me to disagree with the forecast. I just want to work through the process. Can I get your thoughts on that, Emily, that the average investor expects an economic disaster? Would that be your view?
No, I definitely don't expect an economic disaster. I do think we are in the middle of a bear market rally. And but to Taylor's point, stocks are certainly at a better value than they were at the first of the year. So I'm not a total bear by any means. And I think that if for people with significant amount of cash on the sidelines, the next few months is a good time to be gradually putting that to work, especially because cash drag has 2 years ago, there wasn't a big penalty to a portfolio to holding huge amounts of cash. But no, I'm not expecting an economic disaster. I don't really think that retail investors or American consumers are either. I think you've got very, very record low sentiment, and primarily because of inflation. But I think that the reason we're seeing this very robust bear market rally, which I think could easily continue for a couple of weeks, is because people are relieved that things are not worse than they anticipated. So basically, mixed answer to your question there.
Yeah, Morgan Stanley agrees with you, Emily. They think this can go on for a few more weeks, but ultimately it's the reality check that comes from earnings that takes us back down towards maybe 3,400. Krishna, what I'm trying to gauge is how low the bar is going into earnings season. I've got people telling me that the earnings expectations haven't been cut enough. I've got Marko Kolanovic over at JP Morgan and his latest research, which basically implies the bar is really low because the average investor expects an economic disaster. We won't get one, and we can recover the losses of the first half. I guess from your perspective, Krishna, which one is it?
Well, so, when the markets or S&P, for example, is down less than 20%, that's from a really high level. I don't think that's the market's expecting a total disaster. I think, and the other point is whatever drawdown that you have in earnings is not going to happen this quarter. What we have is decent employment, decent growth, and that will show through in earnings. If there is an earnings revision, that probably, again, as I mentioned before, probably happens in earliest the fourth quarter, more likely in 2023. And it's not unusual in a significant slowdown scenario for earnings to go down. That doesn't mean, but with multiples having already compressed, that doesn't mean that the markets could not rally. I think the driver for the market still is very much the direction of Fed policy. And that direction of Fed policy depends on the direction of the slowdown that we can see in employment. If that materializes, I think we have a floor. If that doesn't materialize, and if the Fed is committed to killing headline inflation, then we are all doomed.
Krishna, we almost went through a full segment without discussing the Fed, then you spoiled it. We'll talk about the Fed in the next segment, and we'll pick up on that point on what this Fed is actually targeting and what it means for this market in just a moment. Krishna and Emily are sticking with us. Going into the opening bell about 18 minutes away, equity futures look like this, up 0.4%, with some movers for you. Here's Abby.
John, well, behind some of that bullish tailwind that you're talking about for stocks, we have Occidental Petroleum rallying once again on the news that Warren Buffett's Berkshire Hathaway is buying more of the stock, 44 million shares. They now own more than 16% of the company. Some see these consistent buys by Berkshire Hathaway, the stock, by the way, up more than 500% from its 2020 low, as a path for a buyout. Vonage popping as Ericsson says it is fully committed to the $6 billion deal, wants to get this 5G, the motivation for the deal done by the end of July. Wynn Resorts up more than 6%. This is the China travel quarantine restrictions have been mainly lifted, or cut in half, I should say, but that's certainly a tailwind, or seen as a tailwind, for Macau, more than 40% of the company's revenue. And then finally, you and Taylor were talking about Nike. There it is, down 2.3% on that forecast for sales for the year being a little bit light, the supply chain constraints, and of course, caution around China. John.
Abby, thank you. Coming up next, ECB President Christine Lagarde taking centre stage in Portugal.
Inflation in the euro area is undesirably high, and it is projected to stay that way for some time to come.
That conversation up next.
Inflation in the euro area is undesirably high, and it is projected to stay that way for some time to come. In July, we intend to raise our policy rates for the first time in 11 years. And we have provided some guidance for our September policy meeting and the rate path that we envisage thereafter.
If you get a chance to read it, decent speech from President Lagarde from earlier this morning, kicking off a busy week as central banks speak. Oppenheimer writing the following: the new week greets investors and traders with plenty to ponder as they measure the power of the rally. Uncertainty remains the order of the day. And Mike, that's not just true of investors, but true of central bankers as well.
Absolutely, John. And it all revolves around inflation. After all, the ECB and Fed have pretty much told us what they're going to do. Lagarde today reaffirming the ECB's base case of a quarter-point move later this month. And last week, Jay Powell and since then other Fed officials reaffirming the market's view that they could go 75 basis points. However, both of them, Powell last week and Lagarde today, saying things could change if inflation changes. And we get some inflation reports this week that are going to show changes, and they're probably going to show them higher. The consensus is the white line, which is the European CPI rate, is going to go up to 8.5%. For the Fed, the PCE index out Thursday is going to be up 6.4%. So that line reverses direction. Much higher inflation. Does that call for a change in monetary policy? Unfortunately, Lagarde and Powell speaking tomorrow in Sintra, Portugal, at the ECB's version of Jackson Hole. They are going to be on a panel with Andrew Bailey of the Bank of England and Augustine Carstens from the BIS, and our Francine Lacroix will be questioning them about their plans, but they won't have those new inflation numbers in hand yet, so we may not get a change in plans announced. But Lagarde did make some news today in Sintra, John. The ECB Friday will begin reinvesting proceeds from a runoff of its QE securities in a manner they call flexible, which means they can use the money to buy securities in specific countries to help prevent a possible debt market crisis as they raise interest rates. You can see in the little box there, Italian rates jumped above German rates earlier when the ECB started talking about raising rates, and they're afraid that we could see a replay of 2012 when spreads really blew out. The flexible plan, one way they're going to try to attack this. A lot of people think it won't be enough, and the ECB has tasked staff to come up with a new plan. She offered no details today. Maybe that is something that she can be asked tomorrow.
What a panel we've got coming up tomorrow. Mike McKee, thank you for that. Francine Lacroix, as Mike McKee pointed out, sitting down with Chairman Powell, President Lagarde, and Governor Bailey, all at the same time, working through a range of big issues. Krishna, I wanted to come back to you. I promised we get to that Fed conversation, so let's do that now. Your point is an important one. Trying to work out what they're targeting and what they're willing to tolerate and what that should mean for your outlook and for where you put money to work. Can you run me through your thinking right now, Krishna?
Sure. So the Fed is on a tightening path. And the question that you have to ask yourself is, what is it that the Fed is looking to do? If the Fed is looking to contain persistent headline inflation, that will probably run into 2023 easily. So that means that they will be on a tightening path for a much longer period of time than what the market is anticipating. If that is the case, the risk for asset prices is significant. Having said that, I think it is more likely that what they are targeting is basically employment costs getting contained. That is, unemployment going up and wage pressures moderating. If that's the case, then they may keep rates high for a long period of time. They may not cut, but at the same time, the pace of tightening may not be as high. And if that is the case, then we have a bottom in sight in the fall of this year.
Krishna, is that just a guess, though, trying to work that out? How much of a guess is that? How much of an educated guess is that?
Well, it is an educated guess. You know, the Powell at the moment continues to talk about headline inflation and how that is what they are targeting. But if that is the case, they very well know that the likely outcome of continuing to tighten to what Larry Summers may be asking, 5-6% at the policy rate. What we are talking about then is a very deep, severe recession that they would have a tough time coming out of. And I don't think they want to be in that situation. So it's an educated guess. They haven't articulated that policy, but that is what the markets are discounting right now.
There is a fear that they have to inflict some real economic damage, a fear that they have to inflict damage on this market, too. We caught up with Greg Peters of PGIM earlier this morning, who said he's betting against easing financial conditions. He thinks they need to worsen. Emily Hill, given what's happening with the world and the objective of policymakers right now, I would ask myself whether it's the right time to own an industrial. But you like Honeywell. That jumped off the page to me, Emily, and I wanted to give you the chance just to run through your thinking there before we close out this segment. Why Honeywell?
Well, it's the highest quality industrial conglomerate in the world, arguably. And it really hadn't done that well, frankly, post-pandemic. And it's positioned to take advantage of all sorts of innovative trends. And I'm not talking about buying Honeywell, by the way, for 3 months. We don't do that. We're long-term investors. But, you collect a yield. You've got a very, very high-quality company, well-run company with an excellent balance sheet, and you're frankly investing in a company that does, warehouse automation that is highly leveraged to ESG trends. And so I think it's a good time to invest in just very high quality, large cap value companies, whether they're industrials or not. Now, for the most part, we do prefer sectors that are a little bit more defensive. So utilities, consumer defensive, but Honeywell is the exception.
Emily Hill, I wanted to talk about that exception with you. Thank you for going through it. Emily Hill alongside Krishna Memani there. With equity futures up about 0.5% on the S&P 500, on the Nasdaq up around about a third. Coming up, the morning calls, and later, investors looking for the bottom of this market. We'll catch up with Crossmark's Bob Dole at the opening bout from New York City. This is Bloomberg. 5 minutes away from the opening bell in New York this morning. Good morning. Equity futures just about positive on the S&P 500 up 0.4%. On the Nasdaq 100 up a couple of tenths of 1%. The bottom for the Nasdaq 100 June 16th. 2 days before that, the top for bond yields on 2s, on 10s in a similar period. Your 10-year right now way off the highs of the year so far, which were 350 a couple of weeks ago, but backing up again just by a couple of basis points to 321.30. Earlier this morning, in and around 325 on 2s right now. 311.37 yields in almost a single basis point. Lisa earlier this morning went through some of the auction supply that you need to look for. The 7-year coming from the Treasury a little bit later. That's the story of the bond market. Here are your morning calls. First up, UBS downgrading eBay to neutral, expecting shares to underperform until investors have better visibility into future growth. Your next call from JMP Securities naming MGM Resorts its top pick within the gaming sector, highlighting the rapid recovery in Las Vegas. That stock is up by more than 3%. And your final call from Evercore, cutting its Apple price target down to 180, seeing headwinds stemming from a strengthening US dollar and slowing PC demand. That stock just about positive, up 0.4%. Coming up, Crossmark's Bob Dole says earnings estimates are still too high. He's not the only one saying it. Lisa Shallard at Morgan Stanley yesterday was absolutely scathing. We'll pick up on that story next. Your opening bell just around the corner. 25 seconds away from the opening bell this morning. Good morning to you all. The state of play looks like this. Positive on the S&P by 0.4%. On the Nasdaq 100 up 0.2%. On the Russell up around 0.8%. We sold the open yesterday pretty quickly. Let's see how this plays out. Right about now, there's your opening bell. Switch at the board and get to the bond market. Your 10-year looks a little something like this. Off the highs of the day, up a basis point on a 10-year, 321.49. In the FX market, some dollar strength in the mix in the last couple of hours. 105.30. Euro dollar negative 0.5%. Going into an interesting week for data on both sides of the Atlantic. We get some Eurozone PCE data on the US side and CPI data on the European side, and an ISM print on Friday on the US side as well, and a ton of central banks speak, so take your pick. At 1.1% on WTI crude, 110.80. China easing some quarantine restrictions, seemingly opening up this idea that we get more demand for commodities. We can talk about that through the day, no doubt, on Bloomberg TV and on Bloomberg Radio. About 40 seconds into this, let's break it down for you. Stocks up about 0.4% on the S&P with some movers. Here's Abby.
John, well, we do have a bit of a better open here relative to yesterday for stocks, with that S&P 500 up about 0.4%. One stock going in the opposite direction, though, and then we'll take a look at those that are helping. Nike shares are down by about 2%, more than 2%. This, of course, after the company basically gave a weak sales outlook. Supply constraints continuing to cause a problem. And, of course, the last quarter was down 20% in China, so fears that that weakness could continue. Shares now down about 3%. Goldman Sachs, on the other hand, up 1.7%. They have of course, along with Wells Fargo, hiked their dividend, leading the big banks by 20%. So investors looking to that, despite the larger losses from the company's consumer unit. ExxonMobil up 2.3%, in line with oil. And of course, that optimism around the China travel quarantine being cut in half, perhaps more demand for that natural resource. And then Apple, you were just mentioning that too. One of the top point boost for the S&P 500 today, John. This, of course, as Evercore has cut their price target, but to 180 from 220 on the possibility of dollar strength hurting and PC weakness. But of course, the stock is well below 180, so that still suggests lots of upside, John.
Abby, thank you. About 2 minutes in, here's the state of play for you, up 0.6% on the S&P. Every industry group on my screen is in positive territory right now. Abby talked about the energy names, Exxon being one. Energy stocks up by about 2.3%. Financials up by more than 1%. Shanali's going to be with us in just a moment. Information technology advancing just about as well, up 0.4%. On the West Coast, let's get to Ed. Morning, Ed.
Yeah, good morning, John. We're up around 0.6% on the Nasdaq 100, although that higher open didn't last very long on Monday, so let's see where it goes. We're also in the last few days of the quarter, right? There's some rebalancing of portfolios, which brings us volatility, but I heard you talking about the bottom on the Nasdaq 100 being June 16th. The other way I'd look at it is that we're still down more than 20% from our March high, and as we enter another corporate earnings season head on, you look at the year-to-date declines of the technology sector relative to the broader market, the Nasdaq 100 relative to the S&P 500. There's some feeling out there that corporate America and some sections of Wall Street are just too bullish. You look, we're up now 0.9% on the Nasdaq 100 following the open. China's easing of restrictions and requirements relating to COVID-19 seems to be supporting the market. But the question is still, how do we cope with inflation in corporate America? And once we look at inflation, we go back to the rate story. We're looking at the impact of yields recently. Last week, we had that best week since March on the Nasdaq 100, but that was at a time where yields were coming down. We've seen some yield volatility creeping in the last 48 hours. So I'll give you a silver lining, John, because I'm a nice guy and you're a good mate. At least with some of that trimming we've seen in the technology sector, the weighting of tech relative to the S&P 500 has come down somewhat, but at the index level, we're still hyper-focused on this sector because I want to know what they have to say about the consumer.
You're the happiest man at 6:30 in the morning in San Francisco, that's for sure. Ed, thank you, mate. It's good to catch up, buddy, as always. I promised you we'd talk about the banks announcing a wave of dividend increases following their stress test results. The Goldman CEO, the chief, David Solomon, said the following: our client-oriented strategy will continue to provide a strengthened return profile to dynamically manage capital and remain well-positioned to support our clients. With the latest, our Wall Street correspondent, Shanali Bassett, joins us now. Hey, Shanali.
Hey, John. And if you take a look at it, it's actually Morgan Stanley that is rising the most of all the big banks, more than 4%. And that's because they were able to also announce a buyback. With bank shares having fallen so much this year, more than 20% for most of the big investment banks, Goldman, Morgan Stanley, and JP Morgan, investors did want to see buybacks from the banks. But remember, most big banks muted expectations. Goldman, however, did spike their dividend more than any other bank, and that, according to Bloomberg intelligence analysts, really makes their dividend much more attractive, much more similar to JP Morgan. But remember, there was not all very positive news across all the banks. If you looked at JP Morgan and Citigroup, they held their dividend stable. JP Morgan cited a reason why, and that reason being higher capital requirements anticipated ahead. Citigroup has previously said also that this would be a tougher macroeconomic environment. I also have to point out that tougher macroeconomic environment for a second, because we did get Jeffrey's results here, trading results. Between both lighter equity debt underwriting, there was also lighter trading, particularly in fixed income. That tends to be a bellwether for the big banks. So will this year be as good as last year? What kind of capital is there left to not only bring back to shareholders at the end of the day, but also redeploy in the business to keep this year competitive, John?
Shanali, build that out just a little bit more. Just one further beat if we can. July 14th, JP Morgan reports earnings. We've heard the commentary from the C-suite, that hurricane headline from Jamie Dimon. What are you looking for in these numbers in a couple of weeks?
Yeah, is it as bad as even the Federal Reserve thinks it can get? Remember, and are there areas that the Fed is not seeing? If you think about it, the Fed stress test really surrounded around the commercial mortgage sector. It's surrounded around credit cards. But there are other pockets of the economy. What about the buy side? Where does trading get under pressure? In addition to the consumer banks that you have to keep an eye on when markets have been this choppy.
Shonali, thank you. And Shonali bringing up Morgan Stanley, just bringing up the stock on my screen, up by more than 4% in the early part of today, 6 minutes into the session. Another stock to look at is Nike, at 1.8% there and thereabouts, raising the losses of this morning. Nike reporting what some consider to be a disappointing outlook amid increasing disruptions in China. The CFO, Matthew Friend, saying the following: we expect gross margins to be in the range of flat to declining by 50 basis points versus the previous year. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, interesting turnaround for the stock here, considering it opened almost 3% lower, but maybe investors clinging to some of the positives, including the growth they saw in the EMEA region as well as Latin America. But of course, it was the headlines out of China specifically that really grabbed focus after this report after the bell yesterday. Sales down 20% in that market due to the impact of COVID-related lockdowns, which Nike said affected 60% of its business there. But I would note also North America was a weak point. Those sales were down about 5 percentage points. And remember, that's Nike's biggest market, makes up about 40% of its total revenue. So our colleague Andrea Felstead over at Bloomberg Opinion says when you look at North America, that may be a sign of consumer demand shifting in the face of high inflation. If you're paying more at the grocery store and at the gas station, maybe you're not going to buy a new pair of sneakers or more athleisure. And you have to pair that knowledge with the fact that Nike's inventory was up 23% to $8.4 billion. A big reason being there are many goods stuck in transit. So Nike says it's going to do more discounting in order to work that inventory down. And that brings us to the margin point, John. As you said, flat to down 50 basis points, not the best news. And analysts really are looking at the fact that Nike says its direct-to-consumer business should help buffer margins. Some are more skeptical, including one over at BMO Capital Markets who cut his price target on the stock today. He's not the only one. And I would note that a lot of these headwinds analysts are talking about, China, supply chain issues, margin pressure, are not unique to Nike. They weigh over the consumer discretionary sector as a whole, which, like Nike, is down about 30% year to date, underperforming the broader market, John.
Some brutal numbers there. Kelly Lyons, thank you very much. I'll tell you someone who was absolutely brutal yesterday. It was Lisa Shallett. I go back home in the evening and I go over all the interviews again and make some notes. And I really wanted to bring you Lisa Shallett's comments all over again from this programme yesterday. Take a listen to what Morgan Stanley's Lisa Shallett had to say.
Economists have begun to cut their top-down economic forecasts for GDP, and yet fundamental company analysts are sitting there like deer in headlights, not knowing what to do with numbers.
Sitting there like deer in the headlights. That's not Crossmark's Bob Dole. He joins us right now. Bob, let's talk about that. Do you agree with that sentiment, that statement that Lisa Shallett of Morgan Stanley's made?
Look, I think analysts have undercut estimates now for several quarters, so I think they're reluctant, despite Lisa's good comment. The economic numbers are coming down, so they're setting themselves up to have to take some numbers down. But I think they'll probably, in many cases, wait until the quarters are released and see what guidance they get for the back part of the year. To defend corporate America, John, you know they've done a great job raising prices to keep up with cost pressures in labor and transportation and raw materials. The question is, how long will you and me and businesses pay those higher prices? And I think we're coming to the end of the rope. So I'm going to agree. Earnings probably are vulnerable here. So,
Bob, walk me through what that means for this market going through this summer and into the end of the year.
Well, I think it means it's going to be choppy. I don't think it has to go straight down. You know, we're in a period where perhaps good news is bad news and bad news is good news. Example, last week, growth was a little bit slower. Some signs maybe inflation's peaking, and the market likes it, takes off on the weak news. So if we get weak earnings, we may offset it by some pickup in PE ratios, which have gotten hammered so hard since the first of the year. So I think we're going to have a very choppy period. I do think short term, we're in our third bear market rally since this bear market started, and it's maybe only half over.
You're happy to call it that, though, Bob? This is a bear market rally, what we've seen over the last week.
I don't think we've seen the bottom, John. I want to see more capitulation. I want to see the VIX climb over 40. I want to see put-call ratios expand. And fundamentally, I would love to see some visibility on potential peak in inflation, peak in interest rates, and some visibility, we're not even close to this one, on the Fed getting to the end of rate increases. That's what I'm looking for to get the final washout bottom. I think that's still in front of us.
And let's throw in this one as well. Peak dollar. Do you think we've seen that, Bob? Because looking ahead to earnings season, it could be a key feature of earnings. It was for Nike. It will be for others. It's going to be for Microsoft. They've already talked about that. Are you willing to fade the dollar strength? And if you are, how do you capture that in this equity market?
Yeah, I am, although in all honesty, I've been calling that since the first of the year and been wrong. I think the fact that relative economic growth in the U.S. has been better, our Fed has come to the fore to raise rates faster than other central banks. That's given some resultant and latent strength in the dollar. But I think the dollar is overvalued. We're going to see some weakness. So that tells you got to be careful about how many multinationals you have in your portfolio, and make sure you have some non-U.S. The non-U.S. averages are down less than the U.S. so far this year, which has surprised a lot of people, John.
I get nervous, Bob, when a lot of people start coming on and saying bad news could be good news, and I just sit here thinking, good news for what? One thing that's jumped out to me, Bob, and I'm sure it has to you, is the amount of people that talk about heightened recession risk, but then talk about a long in energy names through the rest of this year. I just wonder how much longer that can persist, Bob. I think you're right, and of course we saw last week the energy stocks absolutely get, and the week before, underperforming significantly. And in some ways, that's a good sign. Typically, the last thing that gets hit are the strongest stocks. They got hit, although I think the energy story is not over. But you're right. Energy, I like it, and recession in the same sentence are a little hard to fathom. Bob, just a final one from me. If you had to sit in a pocket of this equity market through the rest of this year with a degree of confidence, can you think of a part of this equity market that you'd like to do that with? I want to do it in high quality. Earnings delivery, earnings predictability, balance sheet management. HMOs are a good place to play it. They've done better than the market, but that's a place I'd hide. We talked about the financials earlier. I like them too, but was not mentioned insurance. They're some of the safer places too, I think. Hey, Bob, awesome, as always, to get your view on this programme. Bob Dole of Crossmark, thank you, mate. Appreciate it. About 13 minutes in, we are positive by 1% on the S&P, on the Nasdaq by about 0.9%. Big week coming up for central bankers and global leaders. Up next, the US and its allies ramping up the pressure on Russia and China.
Our new concept will guide us in an era of strategic competition.
That conversation up next.
So, for all those Republicans in Congress criticizing me today for high gas prices in America, are you now saying we were wrong to support Ukraine? Are you saying we were wrong to stand up to Putin? Are you saying that we would rather have lower gas prices in America than Putin's iron fist in Europe? I don't believe that.
Pretty strong words from the President of the United States, using the international stage to push back against those at home and abroad. G7 leaders now turning their attention to China, calling on Beijing to urge Russia to stop its military aggression and immediately and unconditionally withdraw its troops from Ukraine. This according to the text of a statement. Bloomberg's AMH Anne-Marie Tadeo join us now. Anne-Marie, before you depart Bavaria, talk me through what we've achieved in Germany at this G7 meeting.
Well, John, a lot of the stuff that was achieved in Germany is really just setting up the stage for more talks to continue. Of course, there's a lot of urging on a number of factors. That's for the unity, to maintain that unity amongst the G7 and its allies, to support Ukraine, to keep the pressure on President Putin, and then, as you mentioned, of course, to make sure they are steadfast when they are combating against China and urging China to lean more towards the West and stand up for Western values and not continue this support, even though sometimes it's behind the scenes with President Putin. Most interesting, which really got a lot of the talk, of course, is this idea of an oil price cap and as well as a Russian gas cap in Europe. Daniel Flatley, our colleague, just wrote a great piece talking about how it's a Rubik's Cube, and the fact that it got into the text that they want to even continue discussions is a big deal. But for this to actually hit the market, it is going to take a number of laborious conversations with the private sector, insurance companies, shipping companies, as well as massive buyers, especially for crude. Beijing being one, New Delhi being the other, and then Russia, of course, being willing to sell that crude for the cap that Western allies decide on.
This is question number one for me, Maria. Just listening to everything that AMH has just gone through, how do you achieve that oil price cap that they're looking to talk about without including India and China? And at the same time, the president's going to go from Bavaria over to Madrid, and there's the potential for NATO to criticize China. At the same time, they need China on board to do something about Russia. Maria, can you square that one for us?
Well, it's a difficult one to square, but the focus, of course, as you say now here is NATO. But the way they see it is that this is not about the oil cap. It's not about specific countries like India and potentially China on the oil. This is a much bigger conversation now about security and defense. And what they argue is that we're going to see the most sweeping changes to that security definition probably since the Cold War. So this is about the weapons and the politics. It's a different type of conversation to that in the G7. Jonathan, if I could say, well, in my view, the NATO this year is much more important than the G7 will be. We know that there's already indications from the NATO Secretary General Stoltenberg that allies will say that Russia is, quote, the most significant and direct threat to NATO security. This is not just Eastern Europe. It's now the entire alliance. Remember, they're bound by Article 5. If one country gets attacked, everyone will have to come to their defense. When it comes to China, to your point, they will now say openly that this is a systemic challenge to NATO. The language around it will be interesting. And then, of course, we always circle back to the perennial debate at NATO, and that is defense spending. What the NATO Secretary General now says, and what a change in tune here, is that the 2% of GDP is not the ceiling. It's going to be something that could be extended way beyond that. It's not the floor, it's the ceiling.
Stoltenberg also talking about the progress over Swedish and Finnish membership. Obviously, Turkey has some reservations about some of this, Maria. Walk me through the potential for this to happen anytime soon.
Well, Erdogan is the start of day one here. All eyes are on the Turkish leader. Of course, he says he has some concerns about Sweden and Finland. He says they don't fight enough counterterrorism and terrorist operations. Now, a lot of the critics say that this is just Erdogan trying, of course, to get concessions and time with the president of the United States. But I have to say today, Jonathan, the mood has really shifted from the morning to now. And there is optimism that a deal to include these two countries to NATO may be on the cards by the end of the summit.
Range of headlines from Stoltenberg also on China. Disappointed China won't condemn the Russian attack, but they don't regard China as an adversary. Anne-Marie, I want to leave you with the final word here. What would they describe China as?
Well, they're not going to say adversary, but they are going to say that China is strategically a hurdle, if you would. The exact text hasn't been completely defined yet, Jonathan, but they're getting there. A little bit more pressure on China. I would say it's a huge 180 from the last time we got this text from NATO. In 2010, China was not mentioned, but Russia was, and Russia was mentioned as a partner. And part of the reason why they will not go as hard as saying adversary on China is because the country I'm standing in right now, Germany, they have massive, among other European allies, have massive trade with China, economic ties, business ties, and they want to make sure they can balance these two struggles.
The weak link on two big geopolitical issues is Germany seemingly all over again for many people. AMH, wonderful coverage. I know you've got to catch a flight over to Madrid now alongside Maria today. And I just get this sneaky feeling I'm missing out on something this weekend in Madrid with the two of you.
Oh, you are.
Having a very good time. I'm aware. Maria Tadeo.
Never reveal private details, Jonathan, on camera.
I'm not revealing a thing, and neither are you, apparently. Coming up, the trading diary. The market-moving events you need to be watching. That'll be next on this programme. With your equity market shaping up as follows. A lift up 1% on the S&P, advancing 40 points, up 0.75% on the NASDAQ from New York City. This is Bloomberg. 25 minutes into the session in New York this morning. Good morning to you. Last week, energy stocks got absolutely hammered. Yesterday, they bounced back and they're climbing aggressively again this morning by 3.5% rather. So far, up 1% on the S&P. On the NASDAQ, up about 0.7% or so. That's the price action. Here's your trading diary. President Biden meeting with the Prime Minister of Spain in Madrid. That's coming up at the top of the hour. Plus, San Francisco Fed President Mary Daly speaking at 12:30 Eastern. Central bankers in focus. Wednesday, the big one. Powell, Lagarde, Bailey, all on one panel in Sintra, Portugal. Plus, a look out for US GDP at 8:30 Eastern. Personal income and spending numbers and US jobless claims coming out on Thursday. And finally, rounding out the week with the big data point of the week. On either side of the Atlantic, you get ISM manufacturing numbers in the US. And over in Europe, you get Eurozone CPI on Friday too. From New York City, that does it from me. Thank you very much for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.